Just a quick overview of what we're going to do today. We're going to do a little bit of a background on OICR. We're going to deep dive on the Perpetual Purpose Trust, and then we're going to talk a little bit about what's next, the next session that we're having for OICR, as well as the next working group that we're going to have. So for those of you that don't know, and if you could go one more slide, I also want to acknowledge, and it's really exciting because Tiedemann Advisors at the end of last year gave us a wonderful donation. And for those of you that don't know Tiedemann Advisors, they partner with individuals, families, foundations, and endowments on values-aligned impact investment, estate, and philanthropic planning. They manage $1.6 billion, which is committed to impact strategies, and Brad Harrison and Kate Donnelly are here tonight, and they are in the Portland office located in the Pearl. So we're really grateful to them to help us make this series possible. And then Catalyst Law and my organization, TechSoup, have also been generous with in-kind support. So with that, Kate, do you mind moving forward one? Thank you. So the vision for OICR, supporting a vibrant and inclusive economy in Oregon through education and collaboration. Kate and I and Astrid Scholes and John Haynes were all together last summer at an event in New York, and we were hearing about all of these really interesting, innovative activities around moving money towards social impact in Oregon and the Pacific Northwest that we didn't know anything about. And we realized, we should know more about this, and where are we coming together to talk about these things? And so Kate and I decided we're just going to bring a couple people into the Catalyst Law office and talk about this every so often. But as we had more conversations over the summer, we realized that a lot of people were looking for this, and we had about 175 people RSVP to our first event, and a lot of expressions of interest from people who couldn't come. So we moved it downstairs to the auditorium, and we had a couple outcomes from that, including, we shared, Tobias Reed, Treasurer Reed, presented how the state invests. We had Grace Stratton from Senator Wyden's office talk about what they're doing around access to capital for underestimated founders. She'll be here in a little bit to talk about the progress. We heard from Ashley Henry, who was talking about a nascent movement, a nascent activity to try to rally the state around access to capital, and we'll hear a little bit more about that later. And then we committed to hosting some speaking sessions, some speaker series to learn together, and also these working groups. So that's what we'll be doing throughout the rest of the year, and we'll share more at the end. With that long preamble, Kate is going to take over here.
They're getting settled. I just want to tell you a little bit about our panelists. Natalie Reitman-White is Vice President of Organizational Vitality and Trade Advocacy at Organically Grown Company, and she's also recently started a company called Alternative Ownership Advisors to work with other companies who are thinking about transitioning their ownership structures. We've got Stephen Bell and Ron McFall from Stoel Rives, who are the lawyers that worked with Organically Grown on the Perpetual Purpose Trust model. And so I'm going to just sort of moderate and ask them some questions, and then we'll pass the microphone so that everybody can hear answers. If you can't hear in the back, let us know and we'll adjust the volume. So my first question for you is just to tell us the story of Organically Grown and how you came to adopt the Perpetual Trust model.
Okay, and we do have some visuals to go with our story.
Okay.
For the visual learners in the room.
There we go.
Hi everyone, thanks for coming. So I'm Natalie Reitman-White. I've worked with Organically Grown Company for 15 years. Organically Grown Company is the largest distributor of organic fruits and vegetables in the Pacific Northwest. So we're kind of in the background, the people who are picking up the food from the farms, and the infrastructure providers providing farmers with packaging and other things they need, and picking up the product and moving it, packing some of it, packing in our facilities all the way through to the stores that you buy the produce at, or the restaurants that you buy the produce at. So we're very much an infrastructure provider. We've been around for 40 years. The company was founded in 1978. Maybe let's go to the next. There we go. Okay. So form follows function. So I want to talk a little bit about what we do, and then how we're trying to find a corporate ownership and financing form to be complementary and enhance what we do, rather than pull us away and distract us from what we do. So why does Organically Grown Company exist? Why was it founded? Organically Grown Company was founded because people in Eugene, Oregon were concerned that the food that people were eating was unhealthy. So they wanted to work with farmers to produce organic food and to bring that organic food to the community. So it was actually first started as a nonprofit of community gardeners and activists trying to get educated in organic gardening methods. They were going to the extension agents, and the extension agents, they were looking for organic methods of pest and disease control, and the extension agents were laughing at them, telling them that they didn't know where they could find those methods and go back to their communes. So people in Eugene, Oregon were trying to share those resources around organic gardening methods and trying to increase access for people to healthy organic foods. Quickly realized that probably the best way to increase access to organic foods was to help farmers who were good at growing food make a living growing organically. And so actually switched from a nonprofit to an agricultural marketing co-op that could help provide agronomic services to farmers to transition to organic and actually help them make a living getting those products to marketplace and growing a marketplace for those products and creating the economic pull-through for them to change their practices and to actually put a good-looking product on people's shelves that didn't look swaggy and maggoty. So that was the inception. So that first we were a Vista volunteer grant to kind of help us form a nonprofit and then eventually move into an agricultural marketing co-op. And shared a check, shared a facility, shared an agronomist. Organically Grown grew and grew and grew. We were part of forming Oregon TILF, the Oregon Organic Standards, which preceded the National Organic Standards. Now people were starting to get turned on to this stuff. They were looking for year-round organic produce. They were looking for organic bananas and organic citrus and other things. And we had our product kind of May through October, and then that was about what we offered: apples, pears, cabbages, etc. And so people were looking for organic in the off-season from other wholesalers. And OGC decided that, hey, we could fill our trucks and fill our facilities year-round and actually give the farmers an additional income stream should their crops not be great this year and their production come on late or end early, that they could fill in their product with product from elsewhere. So started developing wholesale relationships with farmers across California into Mexico and so forth, so that we were the one-stop shop for organic and we could put our farmers' product first. Some of the lawyers that we were working with said, actually, wait a minute, this was at Stoel Rives at the time, this is starting to come into conflict with agricultural marketing cooperative laws, because you're starting to sell more than just your farmer's product. And that's actually, if you grow the maximum of what you can grow in the Northwest, if you look at your produce shelf year-round, about a third of the volume can come from the Northwest, given how people currently eat. Now, if people switched over from bananas to rutabagas, it'd be a different story. But given what people currently eat, about a third of the volume for the year-round could come from the Northwest. So we were starting to wholesale more than 50% from non-farmer members. So we had a choice to make. Do we become, it was a strategic operational choice. Do we kind of shrink back to just be an ag marketing co-op, stay within those rules, or do we continue to pursue this operational strategy of being a full-line distributor and switch our corporate form? We decided that distributorship was the right strategic move that was best for our farmers, so we switched to a C corporation from the co-op, and we transferred the original farmer shares proportional to what they had in the cooperative. At that time, we started to have a group of employees who were working for us, right? People who felt like they were adding value through their labor, being warehousers, being salespeople, being truck drivers. They weren't farmers, but they were doing something to grow the organic movement. Shouldn't we be co-owners too and participate with the farmers in decision-making about how this company's run, where we're going, what our plans are, and shouldn't we share in some of the income that's being generated here? The farmer said, it's a pretty good argument. You guys are adding value too. We want you to be co-owners. Come buy some stock. So then we had this hybrid S corporation owned by farmers and employees. Grew and grew and grew. There's a limit of 100 owners in an S corporation. We had well over 100 employees. We had young farmers coming on. It didn't seem very fair that some people got to participate in the decision making and be owners and some people didn't. So being a cooperative organization, we had a CEO who decided we could put on an employee stock ownership plan. They would be one owner in the S Corp, and you could have hundreds of employees in that employee stock ownership plan. And it'll be this great thing because some of our folks are getting old and they need to look to retire their shares, right? They're not going to sit on those shares forever, and they're going to need some liquidity out of those shares, and that needs to be passed for the next generation. We can do this. So, comes all the way up to 2008. I'm sitting on the board of directors, kind of as the next generation, and actually in charge of human resources, looking at this employee stock ownership plan that's gaining in its ownership of the company and looking at the future. And I saw some red flags, and I started raising those on the board of directors. Some of the, so picture I want to paint here is very technical. Don't get lost in the technical details. We're basically always trying to find what's the appropriate owner to be making the decisions in the company and also sharing in the income and wealth that's being created in the company. And how is that reflective of our mission, of who we are and why we exist, and also who we want to reward, and how is it also fitting with our strategic game plan in the marketplace over time. So I'm looking at what is the future, and it's looking like this employee stock ownership plan is going to take over everything. So we're no longer going to have farmers as owners in our governance. We're no longer going to have farmers kind of sharing. And what's that going to do to our strategy, right? Part of why we're a preferred supplier is because we've had that farmer representation, and we've had a three-legged stool of farmers, employees, and community members on our board to keep us balanced. And I actually think that that creates a better, more competitive game plan. Some people say farmers are always going to want the most they can get, customers are always going to want the cheapest they can get, employees are always going to want the most they can get. And so if you have this balance, it actually creates a good business model. So we're going to lose that, and we might become myopically focused on just the employees and kind of lose our mission of reinvesting in the farmers and the supply chain. So I wanted something that could accommodate our different constituencies and keep us balanced from a governance perspective and also a reward perspective. And that employee stock ownership plan was kind of on this trajectory to take over. In addition, there are some specific concerns that I wanted to bring up. Employee stock ownership plans caused us to go from book value, which is actual assets that we owned, that the company was worth, towards fair market valuation. That's part of the ERISA, Employee Retirement Income Securities Act. I'm not a lawyer. How many of you are lawyers? Lots of you. Okay, but you have to get an independent third-party valuation. And what that does is it builds in a lot of future aspirations about what your company might earn and how much it might grow, and that you haven't actually actualized. And in the organic marketplace, as in a lot of sustainability sectors and a lot of growth sectors, sometimes valuations start going crazy that are very detached from reality in terms of companies being bought for 40 times their earnings, which is just insane. Thinking about especially agriculture, low margin agriculture. So we found that we had signed up for this plan that was potentially pegging us to speculative market behavior and kind of funny money, in my opinion, versus actually realized results that could drive us to be paying more for our stock than was actually realistic for the long term and very sustainable. And I'm a sustainability person. I'd rather pay as you go with what you've actually achieved versus kind of having all this blue sky built in. Additionally, I found ownership's not for everyone. We have a diversity of employees. We have young warehousers who are 20 years old and trying to go to night school. We have people who are close to retirement. We have salespeople. Not everyone wants stock as compensation, and it's not an appropriate form of compensation for everyone. Some people just want more money in their pocket today. And so with a plan like that, you have to allocate everyone's stock as part of compensation in an equal way, and it just doesn't fit for all stripes of people. And not everyone wants the governance of ownership, quite frankly, as well. The other thing that it does is threat of unwanted acquisition. I know folks at some of my favorite breweries that worked really hard to transition to employee ownership, actually have their employee stock ownership plans after working to transition into them sell the company. Either the trustees felt bound to sell the company because a bidder came knocking and the valuation was so high that they couldn't refuse because they have to maximize the value of the employee retirement plan, even if that new buyer might get all the jobs and move the company elsewhere. If they're going to pay a high multiple, they have to entertain that offer. And sometimes for employees, it's hard to resist, right? Like, hey, there's this shiny thing. But the notion is that that kind of robs future employees and all those people that could continue to build the value towards that mission into the future. So we wanted to protect against acquisition, keep the decision making with people who are involved in the company day to day. We wanted to reward active contributors in the business in a way that they could then take and use that money in a way that they wanted. If they wanted to build long-term wealth, they could, or if they wanted to use that money today. We wanted to, actually, let's go to the next slide. Yeah. We wanted a model that would be financially sustainable and resilient, that would promote co-ownership culture, that would reward people who are active with us, our farmers, our employees. We broaden it to our customers, right? They're a key part of our success. And our supply chain. We wanted to distribute governance and rewards, and we wanted to maintain independence in our thinking and our action.
Let me add one thing that I think I dropped off the slide. One of the other key objectives was a fair market value exit for the legacy stockholders.
I'll add one other thing. We had never taken outside money in 40 years of the company. We'd always bootstrapped the company by just taking our own profitability to reinvest back into the company. So we've actually run a company that's been very lean and just reinvested the bulk of the money back into the company, maybe taken out some debt, paid off debt early, and so we were afraid of, because we'd always been afraid of what outside investment might do to taking control away from the people who were close to delivering the mission every day and really wanting those people to be able to make decisions that we felt were fair to the farmers, fair to the employees. And I also started to kind of push the thinking there. Couldn't some outside investment actually help us accelerate our mission? Are we being too conservative here in wanting to hold on to control so tight that we're not looking at people coming to us from the community who would like to invest in us, and we could use that capital to actually grow our infrastructure? How might we do that in a way that would be appropriate, where we wouldn't sell control, but we could grow our impact, and they could share in that impact as one constituent, just like our farmers, employees, et cetera, but not take everything? How could they get some returns on balance and help us accelerate our impact? So that was the other requirement that we were looking for.
Okay. You ready for the next question? So the next question is, please describe the Perpetual Trust model.
Well, that's not where we were going next. But let's see. Could you go forward?
Yeah.
1, 2. Let's see. Okay. All right. Maybe this is the place to start.
So we gave Ron this criteria. We said we want to be independent, we want to be actively rewarding, we want to do these things. What is the model? We've been these 4 other things.
Actually, I'll tell you what. Let's go back 2 slides, and I will quickly go over this. When I started working with Natalie and OGC, it was kind of like, okay, I've got this list of objectives, and it does not fit neatly into anything that's a standard corporate transaction, right? It's something totally different. The set of objectives are inconsistent with the normal transactions. And so we started trying to reason our way through what structure can we create that will allow them to do all of these objectives, allow the company to do all these objectives. And we started out by thinking, okay, can we just do something at the entity level itself where we change the form of entity in such a way that it creates the ability to lock in the mission, to get the exit that the company wanted for its existing stockholders and so on. And so we went through the choices. Okay, if it's a for-profit entity, the default setting is that you're going to maximize profit. There are obviously exceptions to that. There are exceptions for nonprofits. There are exceptions for benefit corporations. And we spent a lot of time talking about and thinking about the possibility of turning OGC into a benefit corporation. And we actually did that as part of the restructuring. But the conclusion that we came to was that benefit corporation status was really only half the protection that was needed to preserve the mission of the company long term. And the reason we thought that is for a couple of reasons. One is that most benefit corporation statutes do not explicitly overrule the Revlon case. The Revlon case is a famous corporate law case out of Delaware that essentially stands for the proposition that at the point in time when a board of directors makes a decision to sell the business, their fiduciary duty at that point switches over to maximizing profit, right? And so that's one of those things where, as Natalie mentioned earlier, you get an unsolicited offer that is big enough and in proportion to the value of the company that you actually have have to respond to it. And so one of the things was, okay, benefit corporation status, except for the Delaware Public Benefit Corporation Statute. The rest of them don't explicitly override Revlon. And the other thing is that at any given time in a benefit corporation, if a big company shows up with a checkbook, the owners are going to be tempted. The owners can change the status, the benefit corporation status, by a supermajority vote and take away that protection, at which point it turns back into a normal corporation. So we came to the conclusion that the benefit corporation status by itself would not be a sufficient protection to maintain the mission of the company long term. The other thing we spent a lot of time talking and thinking about is whether we could use a cooperative structure. And I've worked with cooperatives since the beginning of my career. That's been kind of a parallel path in my work. And, you know, there are certainly multi-stakeholder cooperatives out there, and we were thinking about the categories of stakeholders that OGC wanted to have involved. And it's like, okay, we can fit most of these into a cooperative, but one of the key elements of a cooperative operation is business on a patronage basis. And patronage is business done for or with the cooperative. If it's a marketing cooperative, it's the producers selling their goods, they're marketing their products through the cooperative. If it's a supply cooperative, they're buying inputs from the cooperative as supplies. And some of the categories, you know, it was pretty clear that there was a patronage relationship or would have been a patronage relationship if we moved to cooperative with, you know, obviously the farmers. There would have been a patronage relationship with customers who were buying goods, buying supplies from the company. There could have been a patronage relationship with employees, but we had two other classes of stakeholders that OGC wanted to have involved. They wanted to have, as Natalie said, kind of the non-controlling investors, mission-aligned investors, and under existing co-op law, that's just not a patronage relationship. An investment relationship is not business for or with the way the IRS defines it. And then the other thing is the company wanted to be able to move in the direction of having the community as another stakeholder group as well. And again, there wouldn't be a clear patronage transaction. And so because of that, we considered, I think we spent probably a couple of years with committees from OGC kind of thinking about and kind of working our way through the possibilities. But we considered and rejected kind of the changes at the entity level itself as being a complete solution.
So we didn't spend a couple of years on just that one question.
Not on just one question, there's a whole bunch of other things, but. So then, you know, the next thing we thought of, okay, if we can't get our complete solution at the entity level, let's think about the ownership level. And so, okay, can we find an appropriate owner? And it'd be nice to find, you know, the wise philosopher king to buy the business and make wise decisions going forward. But those people are hard to find and they don't live forever. You know, and if we put it into another for-profit company as a parent company, holding company for OGC, that just pushed the problem up a level. You know, and nonprofit entities were a possibility as well. But one of the things that Natalie and OGC have emphasized is the involvement in the marketplace, the activity with the small producers and so on, that's really kind of inconsistent with a nonprofit activity. It's not a charitable activity, it's affecting change through the activities in the marketplace. So we didn't think that we could find kind of an appropriate style of owner. And then it's like, okay, can we create one? And that's how we got finally to the Purpose Trust structure. There were some examples in the UK about employee ownership trusts, which were specialized trusts that are focused on the benefit of employees alone. And it's like, okay, there are purpose trust statutes, and Stephen will talk about them in some detail, but we thought, you know, let's see if we can have a purpose trust that is focused, that becomes the owner of the business, and that, by virtue of being the controlling owner, allows the company not to worry about an exit strategy for its primary stockholders, and it allows the company to focus on the different groups of stakeholders that we've outlined here. And so kind of that's the direction that we went. We thought, okay, let's take, there are purpose trust statutes out here, but they have historically, and Stephen can talk more about this, but they've historically been used by wealthy people to, do things for their pets after they passed away. Leona Helmsley comes to mind, that kind of thing. And so it's like, okay, let's repurpose this statute and use it as a business ownership tool. Have the next slide, please. And we've got some things wrong with our slide here. So essentially, what we ended up with is a trust that is focused not on a benefit to a particular group of beneficiaries, but is focused on a benefiting a particular purpose that is involved in the it was established and created as part of the trust ownership. And we wanted again to have that fair market exit that I mentioned earlier. We wanted to have the ability to have a variety of different stakeholders that were participating, and we wanted it all to preserve the mission of the company going forward. So we moved in this direction with this kind of a trust. Next slide, please. And so, what we were really trying to do, and I love this slide that Natalie and her team put together. The idea is that instead of the company serves to create profit, the idea is that the profit of the business serves the company and the mission going forward long term. So, okay, next one, please. And so as I mentioned before, and I'll go through the next couple very quickly, the idea is that we have complete control because the voting stock is held 100% by the trust that has these provisions that says we are your majority stockholder. We want you to operate the company profitably, but we want you to operate the company in connection with this mission, this purpose that's established. But at the same time, instead of just leaving that in the trust documents, we made parallel changes in the articles and bylaws of OGC itself. So both documents, they're mirror images of each other that essentially say, our majority stockholder is telling us to operate the business for a particular purpose and mission, and it's written into the articles, it's written into the trust agreement, so it's both at the ownership level and at the entity level as well. Next slide, please. Natalie, do you want to do the financial flows?
Yeah. Well, these arrows got messed up here.
Yes.
Hello? I'll just, there's a button. I'll just shout. There you go. Okay. These arrows should actually be going this way. So we now have a single common stockholder that never wants liquidity, right? That stockholder is not a person, so it'll never die and it never needs to retire, right, and get its liquidity out. That single common stockholder will hold the enterprise value of the company into perpetuity to never sell it. And it also never needs a dividend because it's not a person that needs income, et cetera. It's just a trust, and it says take 100% of your income, keep the business financially healthy, right? Sell products and services that deliver on your mission, and reinvest what you're making back into that mission as you go. So that means reinvesting into the farmers that are delivering the value, say through farmer services or discounts on things like packaging or the packing lines that we put in. Reinvest in your employees through wages, benefits, profit sharing. Reinvest in your customers through giving them the best pricing that you can do, et cetera. Reinvest in the community, so we have like a community advocacy program where we have nonprofit and advocacy groups in organic and sustainable agriculture who are working on solving problems like citrus greening disease, which is a pernicious problem in citrus. We'll give grants to folks working on those issues. So we're basically a for-profit, healthy company that's selling over 100 million pounds of fruits and vegetables a year, but we're taking that income and recycling it at the company level, and it's not going up and out to the trust, except a small budget for the trust to administer. So we have a trustee that we have to pay, we have a trust protector committee that sits in as the manifestation of the owner's wishes to make sure that the board is accountable to the owner's wishes, which is to carry out the mission of the company. So that what it allows us to do is take all the income that we're earning at the company, and reinvest it in real time back into the business and back into our stakeholders. So our goal is to actually make very little net profit at the end of the year because we have reinvested it and shared it back out through profit sharing, through additional OPEX and CAPEX that continues to fulfill our mission back out to farmers, back out. So it's this cycle where it's being recycled, reinvested in the company, this says, and distributed to stakeholders, employees, farmers, and customers. And then we have preferred shareholders, which have provided some capitalization to the business they get an annual dividend that is a portion of the profit sharing. So we have like, here's the profit sharing pie, you guys are getting one chunk, these guys are getting one chunk. So they're not pulling all the value out, they're pulling what we think is a sustainable amount out on balance with reinvesting in the mission and sharing with the other stakeholders. They also don't have the steering wheel. The steering wheel is up here. So this steering wheel is saying run the company long term. But we have an agreement with them. They have certain protective provisions that we can't run away with their money and that we're going to pay a portion of our profit sharing to them over time with a base dividend and some additional profit sharing. And they don't own the underlying enterprise. So when they leave, they put in $5,000, they get $5,000 back when they're ready to go. While their money's in, they're earning their dividend, they want to go, that's fine, we'll pay them back that money. But it's not about driving up the stock value, which is what most board members are fiduciarily responsible for, that those shareholders are going to exit with a higher value than when they got in. Our board is responsible to delivering on their dividend and also reinvesting in the company and sharing. And we obviously want to keep them healthy so they keep their money in so we can use that money to do expansion of our mission. Does that make sense? So those are the financial goals.
I think we actually have kind of the
here's our cash flow waterfall, and we will share these slides. But it's basically first reinvest in the company, service our debt, keep some operational reserves, which is healthy, do our base dividend, share with our coworkers, do some redemption requests, and continue to share the upside with our 5 stakeholder groups.
And then in terms,
These arrows should also be going.
yeah, they got ported over.
They got converted to PDF and maybe that missed it.
But we'll resend everything and we'll make sure that they're
Yes.
boxed out.
In terms of the governance of the trust, I'll go over this really quickly and then we move back to Kate's questions and Stephen's. But we essentially have kind of 3 bodies. We have a trustee who, as Natalie said earlier, is purely an administrative trustee. You know, we didn't want a trust company making the decisions for the business. And so part of what's built into the trust is that the trustee is a directed trustee, and Stephen will describe that in greater detail. So we have the trustee who's doing administrative things. We have a trust protector committee, which essentially is the board of directors of the trust. It's essentially the board of directors of the stockholder. And so it's essentially responsible. It has responsibility for making sure that the company is acting in accordance with the mission established in the trust and in the Articles of Incorporation for OGC. And it ultimately has the authority to elect the board of directors of the operating company. And so that is a significant amount of power. But those TPC, eventually they're selected by the stakeholders, but the original group were people who were selected by the company, who have extensive history and kind of long involvement either in organic or sustainable food production or in business, significant individuals. And then over at the right, we have the trust enforcer, which is a kind of a interesting concept, at least to me as a corporate lawyer, not being a trust lawyer. But essentially, when purpose trust statutes were adopted, they're saying, well, you can get rid of, this is a trust that doesn't have any individuals as beneficiaries. And historically, as I understand it, the point is that ultimately it was the beneficiaries who had the ability to enforce a trust, to go to court and say, hey, trustee, you're doing something, you're not appropriately using the assets in the trust. And if you have a trust that doesn't have any beneficiaries, who's going to fulfill that function? And so what the legislatures did when they created these kind of things is they created a statutory position that allowed a designated party to be there as the beneficiary, not financial beneficiary, but the person entitled to enforce the trust if things go off the rails somewhere along the line. And so we essentially have those 3 up at the trust level, and then we have the OGC board, which is the operating company board, which in some ways is now freed up to focus more on expertise. Because historically, one of the things, as Natalie mentioned, the kind of OGC had this three-legged stool, of community, employees, and farmers, so you had kind of those voices represented on the OGC board. Now, to a certain extent, that's up at the Trust Protector Committee level, and the OGC board has greater flexibility to select people on the basis of particular expertise, industry knowledge, those sorts of things. So that's kind of a quick overview of the governance. And
Question. So you chose to use Delaware law. So Stephen, can you talk a little bit about that choice? And then I don't know if we've talked about this yet, but you also participated in getting a new statute here in Oregon, which makes Perpetual Purpose Trust, or the statute is actually Stewardship Trust, right?
Yes.
Yeah. And so tell us a little bit about how the new law compares with current Delaware law.
Yeah, absolutely. I think from my perspective, so I am a trust and estates and nonprofit lawyer primarily, and so this is the part that seems fun to me. Apologies if it's not to everyone else. So the question came in, and all this exciting planning was going on, and said, well, can we get from point A to point B? Can we utilize a trust structure and tap into the fiduciary duties and the protections under trust law to restructure Organically Grown Company? And so we started thinking creatively about this under the landscape as it existed a few years ago. So before, and Natalie should share in the credit for helping with the new statutory provision and as part of the work group or result of the project here. But at the time, we thought, well, there's some issues potentially with Oregon law. And thinking about the non-charitable purpose trust statute, as Ron mentioned, it's really a quirky part of the trust code as it stands currently. And so there's the pet trust, which some folks are familiar with, a trust without an ascertainable beneficiary, really for the care of an animal. It's kind of a classic idea maybe of having a trust that maintains a grave site in perpetuity. But it's this weird hybrid. There are no beneficiaries. It's not really for a charitable purpose. It has some defined mission. But the statutes that authorize these types of trusts are pretty broad. There's nothing, with the exception of some special pet trust statutes and now the Oregon Stewardship Trust statute, there's usually just a broad, open-ended authorizing statute. And so we thought, well, maybe this mission-driven company and the purposes and the missions behind Organically Grown, these ideas that we want to lock into place, could be the purpose of a non-charitable purpose trust. And that's ultimately what we ended up looking at. If we maybe switch to the next slide. And so thinking about what would be the most logical for an operating company going forward, knowing that we could carefully define that purpose, we looked at several different things. We wanted to make sure that, first of all, there is an authorizing statute. Again, most states do have one, the UTC, and Oregon does have a generic statute. But there's other issues that sometimes don't make sense when you're thinking about this different application of the non-charitable purpose trust statute, one of which is the rule against perpetuities. And my apologies to everyone who went to law school, but the rule against perpetuities is this idea that trust can't last forever. And so at some point in time, it should terminate. And different states take different tacks. Oregon has a 90-year rule against perpetuities, which for most purposes suits anyone's needs. The trust can do what it needs to do within 90 years. You know, we're optimistic. We hope that Organically Grown Company is still operating well beyond 90 years into the future. So that was a bit of a turnoff for Oregon law. We also wanted to
We
think
didn't want to have to unload all the company stock to do at some point.
Exactly.
Like that's why we settled it in the trust, is to keep it operating to the mission.
And so we're looking for this limitation or unlimited duration of the trust, and so that limits us to certain jurisdictions. Of course, we're looking at things like fiduciary income tax. I will spare you, those of you, the tax considerations, but thinking about what is the best state, also looking at the trust law more generally. And so under what circumstances can we change the trust in the future, knowing that there's unforeseen circumstances. So we can try to predict as much as we want going out into the future, but ultimately we want some flexibility. We want to have limited court involvement, and we don't really want a situation where someone can second guess the trust purposes, the trust assets, knowing full well from the outset that the intent here is that this trust is going to accumulate assets. It's going to have the company 100% of the common stock, hopefully continuing to grow. And so some states, including Oregon, had provisions in the law that made it questionable whether or not a court could second guess that in the future and say, well, this trust is a fine idea, maybe it's authorized under the law, but is it appropriate to have a company worth, tens or hundreds of millions of dollars owned by this trust? And we didn't want to get into that potential situation. And so I guess maybe flipping ahead, the result of that is we started kind of casing about what state is really going to suit us. And we identified a couple candidates, but Delaware looked the most favorable. And so the Organically Grown trust, the sustainable food and I'm mixing up my language.
Oh, it's easy,
The-
Sustainable Food
Food,
and Ag Perpetual Purpose Trust.
Yes, I'm thinking about the acronym in my head. I'm like, wait a minute, I'm mixing up the order. So the trust, we ultimately did select Delaware law. We used a directed trust format as stated. So a administrative Delaware trustee is the corporate trustee. This trust protector committee then is really controlling most of the trust decisions, taking all the actions as a shareholder, directing distributions, had other administrative powers. So I think then maybe flipping forward to get to Oregon, so we talked a little bit about,
More, tell me
yeah, right there.
Gotcha.
So I'll skip the prior frameworks, I kind of told you about that, but ultimately then the idea became, well, this is exciting that we were able to entertain this type of project, we were able to put this trust together, but I think it left us feeling a little bit disappointed that we couldn't do it here. Why can't we put this type of structure together here in Oregon in the Pacific Northwest? And so discussions that resulted from this restructuring, and as I mentioned, Natalie's a part of that, and a couple others, Representative Fahey out of Eugene was generous enough to sponsor our legislation and look at, well, is there a way that we can make some little tweaks to the Oregon Uniform Trust Code to make this idea more attractive and more feasible here? And so the result is the new Oregon Stewardship Trust statute. I can't take credit for the branding of Stewardship Trust, but it changed our terminology a little bit. So the idea is that what is a framework, almost like the pet trust, that you could utilize to set up a stewardship trust here in Oregon. So some of the key changes is putting in that framework. There are statutory defaults that can be modified in a trust agreement, but saying, well, you're using a directed trust, you have a committee of protectors or stewards, in the case of the stewardship trust language, that would make certain decisions under the trust. We've enhanced the role of the trust enforcer, which again is this idea of a person appointed to defend the trust, to act as a beneficiary because there are no beneficiaries, giving them certain powers that otherwise belong to beneficiaries. And then looking at some of these technical issues we encountered. So that rule against perpetuities, there's an explicit opt-out in the new law. So if the trust agreement so states, unlike other trusts here in Oregon, a stewardship trust can continue beyond that 90-year rule against perpetuities. And then finally, kind of some technical tweaks in terms of eliminating those questions about second-guessing the level of assets and kind of giving that framework, which we hope will be utilized by other entrepreneurs and mission-driven companies to look at creative restructuring.
So I am going to sort of cut off the presentation. There's lots more interesting stuff to talk about with these stewardship trusts. It's really brilliant once you start to get into the details and understand all the moving parts and how well thought out it was. But I want to open it up for questions. I have more questions I can keep asking, but I also want to give you all a chance to ask any questions that you might have. And Dara's going to play Oprah with the microphone.
I'm curious about taxes. Where do the taxes occur? Is it just at the benefit corp level, or is there taxes at the trust level?
Yeah, this is not.
Sure.
Yeah, this is not a tax favored structure, and in fact, we don't want distributions going up from the operating company to the trust because that's taxed at the highest individual rate.
Yeah, I guess just to add on to that, so this is a complex trust for income tax purposes, so the distributions and any dividends that are paid up to the trust are potentially taxed at that trust level at the highest rates, as Ron mentioned. And so part of, and Natalie alluded to this earlier, is the idea of having limited distributions up to the trust to help with that issue.
Yeah, so we're Oregon C Corp, Benefit Corp, and we're taxed at the entity level for the cash that we retain and the manner in which we distribute the income. So our employees are taxed to get additional profit sharing. Our investors are taxed in the investment. A lot of it's in kind, so we will spend it as ordinary operating expense. So things like additional grower services or some of the contributions that we're making to the trade organizations and nonprofit, like all of that could be kind of reducing our net income.
You know, that's a really good point, Natalie, because that was one of the things that we were trying to get to. It's elements of a cooperative model where you're trying to operate as close to break even as possible and expense everything that you can. And so there are some IRS limitations on what you can expense. You can't suddenly give a customer some massive rebate that's outside the normal scope of market activity. But the idea is that OGC is now in a position to enter into contracts, create obligations to deduct those distributions to stakeholders in a way that it wasn't before, and the overall effect is to minimize taxation because the money is being redistributed and reallocated in the operation of the business.
Next question.
Hi, I was wondering if you could speak to the reactions of the investors to the creation of the trust.
Sure. Well, we had to buy out our whole employee stock ownership plan and all the farmers and employees who had invested in the S corporation stock, right? So we had to talk to a few hundred employees in the employee stock ownership plan, and like 75, and if you add their spouses, like over 100 people in the farmer and employee crowd. Many of whom were nearing retirement, some of our founders and so forth, and we had to convince them that we were going to buy back all their stock and put it into a trust. And so it was a process that took us explaining why we thought continuing down the path was going to not be financially sustainable for the long-term mission of the company, and had the possibility of the company becoming acquired by, and a lot of them. We've kind of seen a lot of carnage in the organic trade, to be frank. We've seen a lot of friends who got outside investment, or they had somebody that needed to exit, and then it caused a lot of turmoil between the family members and so forth, or they needed. So a lot of people know what kind of loss of control and loss of their baby looks like, and how their company might get gutted over time. So luckily we have a lot of founders who are passionate about protecting what they started and willing to enter into a conversation about selling their stock to put it in something that would protect it long term. And certainly they were also looking out for their retirement nest eggs, so we had to prove that it was also a good deal for them. We especially had to prove that to the employee stock ownership plan trustee, that we were giving a fair price for the stock that was currently in the company. But we felt that we did. We had to. We did a combination of a leveraged buyout. So we borrowed some money. We didn't have any debt going into the transaction, so we borrowed some money with RSF Social Finance to purchase the first tranche of shares. And we said, first we're going to buy back 50% of the shares, and then we're going to buy back the rest of your shares over the next 4 years as we raise preferred stock from the community. And if some of you want to sell your shares and come back in the preferred stock door, you're welcome. We just want to get off the treadmill of needing to constantly buy back our common stock and find the next appropriate benevolent owner of our common stock who will make sure we keep operating to mission. We wanted to be off that treadmill. So the reaction was a lot of education about how it protected our mission, how this was financially prudent for them, giving them faith that we would meet our commitment to pay them down over time, and then all dialoguing amongst each other. And we ended up getting 100% vote. They all had to kind of digest it and work through the process. And for our employees, a lot of them are much happier with not getting something that will be promised someday to them when they're 65. They kind of like knowing, hey, we have a good year, I get to share in that year. Some of them are still getting used to it because we kind of sold the employee stock ownership plan. So they're kind of like, I want to see how this profit sharing thing is working, and they're skeptical. But also some of them are like, sweet, I don't have to wait for that. So
So how about one more question from the group?
Clearly this was a special case, I guess, where you had you had been through a lot of different entities and thought through all the ways that this would work for you. I'm curious where you think this would it work for a startup to say, oh, I like all the values and all the benefits of this, or is it just too complex to go from a startup position? And where is this really not at all appropriate structure as a co-op might be or an ESOP might be?
What we're seeing with startups, we're seeing since this transaction was completed, we've seen a lot of interest in this kind of a structure, and some of it has been from startup and development stage companies. And the structure will work, and we've been able to implement it both with startups and more mature companies like OGC. The challenge with the startup is it changes the access to capital, the access to the capital markets. Because you're looking at a very different kind of investor who is going to invest in a startup without the expectation of control and without the expectation of a kind of a significant appreciation in value. And so how can I say this? My view is that the Purpose Trust is another tool, one of several tools that companies can have if they want to be in that, if they're in that part of the economy where the focus is on mission as much as it's on profitability. And so, for 90% of the economy, this is not going to be the right tool. I mean, the vast majority of people who invest in a company wanted to appreciate value, and they're perfectly happy to sell it and let the mission of the business change after they leave. And so I think there's, it's a narrower part of the economy, but I think it has, at least what we've seen so far, is it has applicability kind of at different levels, both startups on through mature companies. Stephen, Natalie, anything?
I'd say, there are a lot of people who are looking for succession strategies who this is attractive to, because they don't necessarily, their kids don't want to take over their company, their employees don't have the capital to buy their company from them. They need liquidity, they want to know that it's going to continue to be run in that stewardship way that they have been stewarding. A lot of great owners out there that haven't been pulling tons of cash out of, their tons of dividends out and been absentee, they've been engaged, they've been reinvesting the bulk back into their mission. They just want some liquidity and to know that that business will continue to be run to that purpose. And one of the sides that we have is the purpose isn't wishy-washy. We're very specific. Reinvesting in sustainable food and agriculture means this. This is how this will play out, and we can change it over time as the world evolves, but we have to have a super majority of our trust protectors and others approve it. So it is pretty locked in. So think about a lot of founders out there who, they went in to produce products and services to change the world, not to become incredibly wealthy. They just want to continue to see the stewardship of that. And they have built some value that they want out, but they'll take a note or they'll take some preferred stock and they'll settle their company into a trust and know that it's protected over time and have a process for doing that. So I think that's kind of the sweet spot, is probably folks who are or folks who are going out and starting to look for growth capital for that next stage, but they have a good track record and they want to bring in growth capital in a way where they're not selling the steering wheel of the company, but they're selling a portion of the income stream and they have a track record of doing that and they'll bake in a contract as such. That's my impression.
I want to say thank you to the three of you for coming and sharing this with us.
Thank you.
Yeah, thank you all. Thank you so much. Okay, at this time, I'd like to invite up Chris Bright, who is the new chair of Business for a Better Portland, or BBPDX, that some of you may be aware of. As it happens today, there's a strong contingent from BBPDX in Salem that's working on a really exciting initiative that will improve access to capital for underrepresented entrepreneurs. So I'm going to let Chris tell you a little bit more.
All right, is this thing on? All right. Hi, Chris Bright. Thanks to Art and Kate for hosting us today, and that was a great presentation. I really, Stephen, I caught your Philosopher King reference, your Plato reference, you philosophy major dog. So I'm up here to talk about HB 4033. So we're going to have a little, what was the number that I just gave?
HB 0433.
Wrong.
4033.
4033. Cheater. Sorry to put you on the spot. So I'm apparently a game show host today. Really what HB and what BBPDX is doing, and I'm here filling in for Ashley Henry, who sends her apologies. She's been texting me for the last 15 minutes, sending pictures, because right now there is a hearing about HB 4033 going on down in Salem. So what HB 4033, and I'm going to keep saying it like that so that you keep hearing it 4033, so that we all remember 4033. And it's really about creating more access to capital for small businesses. Unfortunately for small businesses, especially those owned by multicultural or underrepresented groups, it's a little harder to get a loan, especially or in rural areas. So really the intent of this is to create more of a access to capital for those organizations, and it does it in a couple of ways. One is creating a $5 million reserve loan that will, or loan guarantee. So essentially, banks can lend to those entrepreneurs, and if there happens to be a default, then this creates a backstop, which would then the government, the Oregon State Treasury would then back up that loan with this $5 million reserve fund. Obviously that's a rare occasion, so in my opinion, I think this is really a very low risk and common sense approach to creating more access to capital and creating more of a motion within those communities that need it that will help them get more sustained banking over time. The second part is a $3 million investment into the Oregon Growth Fund, and really that is meant to, it's a one-time investment to create more loans and more access to capital, as well as some technical assistance to support those same communities. So it's kind of covering two different bases there. And then finally, doing more research and investing in that through HB 4033 to be sure that the impact of those businesses are measured so that we can really have a clear economic impact of the small businesses that are taking those investments, that also others like them, so that it will create more momentum behind their efforts to reinvigorate the economies in their communities and in their geographic areas as well. So the call to action is twofold. One, there is a lobby day that's coming up on February 15th. 13th, sorry. So that's just coming up in, what is that, about a week from tomorrow, I think. Is that, do I have that right? Thanks, Wendy. I'm here with Wendy, by the way. And then also there is if you go to the Business for Better Portland site, bbpdx.org, you can sign a petition that would put your business's name in support of this bill. We're hoping that it's a no-brainer. We're getting some really good sponsorship and lots of great support right now. As I mentioned, Representatives Bynum, Gomberg, and Smith were testifying, and then the Eugene Chamber and the Accelerate Fund and some other folks, small businesses that minority-owned businesses in particular are testifying to that. So.
It is available on the website, but the shortcut is to email that email, hb4033@bbpdx.org, and we'll send you the link directly.
All right. Any questions or comments? Yes. I probably can't answer it, but
I'm just curious. Is the legislation, is it to set up a loan loss reserve or a loan guarantee fund?
Loan loss reserve.
Loan loss reserve. Okay.
Thank you, Wendy. Any other questions that I may not be able to answer? All right. Well, thanks very much for your attention, and we appreciate your support if you can give it. It's really important. It's like I said, a common sense step, a small step, but it's a very meaningful one for those businesses. So please.
There's flyers available at the registration table if you'd like more information.
Yeah. So, and it's got some more data about what those businesses represent to our community, as well as on the backside, the supporting organizations, and then also the different the three steps that really HB 4033 is meant to accomplish. All right. Thanks.
Thank you so much. Oh, it's not on again.
I'm sure.
Okay. Thank you. Okay, so we're just about to wrap up. We have one more. Grace Stratton from Senator Ron Wyden's office is here. If you were here with us in October, Grace was talking about some initiatives, and now there's been a lot of progress. So passing it to Grace to share more.
Yeah, thank you so much. I don't want to keep anybody too long, but it's appropriate that I'm taking up after Business for Better Portland because they're really doing incredible work at the state level, legislative-wise. So Senator Wyden has been working on this issue for several years, and we've kind of come around to a couple key pieces of legislation that Senator Wyden's been able to introduce to help close or address the major gaps that we're seeing, inequities, frankly, in lending for women and POC business owners and entrepreneurs in the country. And so there's two pieces of legislation, two components of the piece of legislation he introduced under the Progress Act, and I think it may have gone out, but essentially using his position on his ranking member of finance, created a tax credit for folks hiring their first employee, and then also another tax credit for equity investors, so that they can basically better incentivize investment in smaller businesses. There's some key parameters around the tax credits that ensure that it truly goes to particularly women and where we see majority of POC entrepreneurs in terms of their income, where they start at. So that's one piece of the work we've been doing, but what Senator Whiten is really geared toward is trying to figure out what we can do here in the great state of Oregon. So one of the things that he's planning to do and going forward, we're still working on what this is going to look like, but we are actively taking feedback and input about what a statewide plan around closing the gap in lending could look like. We know that there's a lot of good work happening in the state already, apropos of the summary we just got about what's happening at the legislature. But we know that legislation, as was mentioned, it's just one step. It's an important step. We want to know what more we can do. And so we're really excited to partner with folks in the state to create a statewide plan. So we really I'd love to talk to folks who are interested in this, care about this issue. It's not just an issue of equity, it's an issue of our economy in Oregon, frankly, and that's what Senator Whiten was able to highlight at the Oregon Leadership Summit. We have some pretty stark figures that look at the opportunity we have if we can truly make all small businesses, all boats rise together. We need to be doing this as a state, and it's time to do it. So we're very excited about the momentum that's happening already. We want to keep pushing for that. So if you have questions, I'll stick around for a bit. I have my card. And that's all I got. Very brief.
Thank you. Wonderful to have you here again.
Thank you.
Sharon.
Yes.
So thanks, Grace. So the final thing we'll just say really quickly here is that we have a couple things coming up. So save the date. We have our next event for the speaker series scheduled, and we'll follow up with all of this via email as well. But we're going to talk about an affordable housing fund that is really being spearheaded by Rakaya Adams and Meyer Memorial Trust, along with Mark Edlin and Gertie Maidlin. And not only to look at that issue and the research around it, but also the replicability and scalability of this particular fund. So it's very interesting. April 7th, same time, 4 to 5:30. Probably here, but we'll reconfirm. And then we have 2 working groups scheduled. So later this month, on February 26th, we've got the Oregon Securities Law. We talked a lot about it at the last meeting, but an Oregon Securities Law working group. Bring your lunch. We'll chat. And then also we're combining 2 of those working groups that some people signed up for at least for the first one, just to talk. We think there's some overlap between the education and think tank groups. So that will be on March 12th at 12. Same idea here. Bring your lunch and we'll chat. We'll send those signups again via email, just as a follow-up, along with the slides that have correct arrows. I don't really know how that happened. Just making guesses about what happened there. So that's that, and then I don't know if you want to close it up. Thank you.
So next steps are, please stay in touch. If this was interesting and exciting to you, please let us know. We're also in the process of scheduling out other sessions for later this year. So if you have a great idea about a speaker or something you've heard about that you want to know more about, let us know. Also let us know feedback about how this went. We know the white chairs are not the most comfortable, but we're open to other feedback. Come and attend the gatherings that Dara just went through, and then spread the word about OICR. So we've had really great interest. This seems to be something people are interested in. I'm interested in it. And so we'd like to just keep the community going, keep the knowledge flowing, and share ideas and knowledge about what's going on in Oregon. So thank you.
And we're also talking about a channel for ongoing communication, because I think there are a lot more questions about things like the Perpetual Purpose Trust. So we'll share more about that too.
Right. So there's a lot more to say just about this topic from tonight. So one thing we're thinking about doing is some sort of online forum where you could post questions and we could get back from the speakers answers to those questions. So feel free again to stay as late as you want. We'll be here answering questions, and thank you again to Tiedemann for sponsoring. This is Kate Donnelly from Tiedemann. And our speakers.
Thank you so much.
Thank you.